Right then, no messing about. Morgan, you're here to give us the big brain take on something that sounds proper dry. A top-down technical asset allocation model. Mate, sounds like something you'd read in a textbook from the 80s. In plain English, what is the bloody thing?
Easy, Tiger. It's less complicated than it sounds. Think of it like planning a night out. First, you decide which part of town has the best vibe. That's your asset class.
Right.
Are we going for the posh bars in Mayfair, the edgy clubs in Shoreditch, or a quiet pint at a local pub? You figure out where the energy is.
Okay, a pub crawl analogy, I'm with you. So you're not picking the specific pub yet, just the area.
Exactly. And you do that using technicals. You look at which area is getting all the attention.
Okay.
Which charts are trending up. So once you've decided, right, Shoreditch is buzzing tonight, you move to the next step, the sector. Which street has the best spots? Is it the one with all the music venues or the one with the cool cocktail bars? In market terms, is it the tech sector or the energy sector that's popping off?
And I'm guessing the final step is picking the actual pub and what to drink.
You've got it. That's the individual stock. The whole point is to put yourself where the party is already happening.
Yeah.
It's a system for finding momentum from the macro level all the way down to a single asset.
See, now this is where I have a laugh. Because in crypto, we've been doing this forever.
Oh, yeah?
We just don't use these dead corporate names for it. You call it a top-down model. We call it narrative trading. The asset class is whatever the new hot story is, AI, real-world assets, whatever. The sector is the ecosystem that's winning, like Solana.
Right.
And the individual stock is the dog-themed meme coin that's up 1,000% this week. We're the same, you and I.
Almost. The key difference is that this model stops you from betting your life savings on that dog-themed coin. It's built on discipline. The reason it's so vital and why it's a huge part of the CMT curriculum is that it forces you to manage risk. It's a systematic way to stay out of trouble. When a trend dies, the model tells you to rotate your cash into the next thing that's starting to work.
Right.
It's your defense against getting caught in a dying narrative.
So it would have told you to get out of tech stocks at the end of 2021.
It would have been screaming at you. You'd have seen the relative strength of tech versus the rest of the market just starting to fall off a cliff.
Wow.
At the same time, you'd have seen commodities, especially energy, starting to wake up. So the model would guide you to sell your Apple shares and buy Exxon. It's just following the money.
All right, Mr. Follow the Money. Let's make it practical. Let's say it's the start of 2023. The market's been hammered.
Okay.
I'm sat on a pile of cash. Talk me through the model step by step.
Easy. Step 1, asset class. You run your analysis. Bonds are still a mess. Commodities are starting to look tired after a huge run.
Right.
But stocks and crypto are showing signs of life. They're starting to outperform everything else. The model says we're on risk on, focus on equities and digital assets.
Love a bit of risk on. What's next?
Step 2, sector or geography. Within stocks, what's leading the charge? It's the U.S. and specifically the NASDAQ. Big tech is flying because the market is starting to price in an end to interest rate hikes. So the model narrows it down to your focus should be U.S. tech.
And then the final boss, picking the actual stock.
Step 3, individual security. You're now only fishing in the U.S. tech pond. You line up the charts of the big players, NVIDIA, Meta, Apple.
Okay.
You use a key tool, relative strength. And I don't mean the RSI indicator. I'm talking about a ratio chart. You literally divide the price of NVIDIA by the price of the NASDAQ index.
Right.
You see this line screaming upwards. That's the market telling you in no uncertain terms that NVIDIA isn't just strong, it's the leader of the pack. That's where you put your capital.
That relative strength thing is actually a tidy little tool. It's basically a way to see who's the alpha in any group, right? No opinions, just pure price action.
Precisely. It's the most honest indicator there is. It tells you what institutions are actually buying, not what they're saying on TV.
Yeah.
The whole top-down approach is built on that principle.
Yeah.
Find strength, buy strength, and stay with it until it's no longer strength.
All right, Mr. Follow the Money, I get it, but it still feels a bit slow for my world. A crypto trend can be born, mature, and die
Right.
in the time it takes a fund manager to get his compliance team to approve a trade.
And that's fair point. The time frames are different. This model is typically used for managing a portfolio over weeks and months. But the principles are universal. You can scale it down. What's the hottest narrative on crypto Twitter this week? Which chain is it on?
Yeah.
And which specific token is leading that charge? It's the same logic, just accelerated to warp speed.
See, you're a degen at heart. I knew it. All right, listen up, everyone. If you want to talk more about this and have a proper laugh, join the Big Short Club chat. The link's in the description. And if you're feeling generous, use our link to sign up to the crypto exchange. It's a massive help, costs you nothing. Don't be a helmet. Get involved.
And before we wrap it up, here's a question we'd like you to think about. We've focused entirely on using this model to find what's strong and buy it. But how could you flip this entire process on its head to systematically find the absolute weakest assets in the market and build a killer watch list for short selling?